Right now, as you are watching this video, there is money sitting in government offices with your name on it, and the only reason you have not received it is that nobody ever told you to ask for it. Not your tax preparer, not Medicare, not Social Security, not the IRS, nobody. And today that changes because I am going to show you 5 specific refunds that American retirees over 65 are entitled to and almost never claim, and I am going to give you the exact dollar amount for each one, the exact form to file, and the exact office to contact, because one of these 5 refunds was created specifically by a new law that went into effect in 2025, and the IRS itself confirmed in April 2026 that millions of eligible seniors did not claim it on their tax returns because their preparers used software that had not been updated to include it. That single missed deduction alone could be worth $720 or more, sitting at the IRS right now waiting for you to ask for it back. But that is actually not the most important refund on this list. The one we are saving for the end of this video is the one that can cost retirees over $1,000 per year that they are paying right now without knowing it, and all it takes to stop it is one phone call and one form that takes 45 minutes to complete. Do not leave before we get to that one. Every refund on this list requires you to take action. If you do nothing, the government keeps your money. That is how the system works. Not because it is corrupt, but because it is designed to pay you only when you ask. So let us get into all 5 right now. Refund number 1 is the senior bonus deduction that tens of millions of American retirees missed on their 2025 tax returns. The IRS confirmed on April 15, 2026, in its official filing season updates for seniors that a brand new deduction exists for the first time in American tax law. For tax years 2025 through 2028, every taxpayer who is 65 years old or older on or before the last day of the tax year may claim an additional $6,000 deduction if they are a single filer, or $12,000 if they are married, filing jointly and both spouses qualify. This deduction is on top of the standard deduction. It is on top of the existing additional senior deduction that already exists in the tax code. It is completely new money that was not available on any tax return before 2025, and the income limits are $75,000 of modified adjusted gross income for single filers and $150,000 for married filing jointly. Below those thresholds, you get the full deduction. Above them, it phases out. The reason this deduction was missed by so many retirees is exactly what the IRS warned about. The deduction was created by the One Big Beautiful Bill signed on July 4, 2025. Not every tax software provider updated their systems in time for the 2025 filing season. Not every preparer at national chains received training on a deduction buried inside a 1,100-page piece of legislation, and the IRS did not send letters to eligible taxpayers saying you qualify for a new $6,000 deduction. The burden fell entirely on you and your preparer to know about it. At the 12% tax bracket, that $6,000 deduction is worth $720 in refund for a single filer. At the 22% bracket, it is worth $1,320. For a married couple where both spouses are over 65, the deduction is $12,000. At 12%, that is $1,440. At 22%, that is $2,640. This could be the single largest tax refund many American retirees receive this decade, and it has been sitting unclaimed since the 2025 filing season ended. The fix is IRS Form 1040-X, which is an amended federal return. You have 3 years from the original filing date to submit it. If you filed your 2025 return and you are 65 or older and your income is below those thresholds, pull your return out right now and look at the deduction section. The senior bonus deduction should appear as an additional $6,000 line item on top of your standard deduction. If it is not there, you overpaid and you can get it back. Refund number 2 is the senior property tax exemption that almost every American county offers and almost no senior homeowner applies for. Every state in America has some form of property tax relief for homeowners over 65. The names change by state: homestead exemptions, senior freezes, circuit breakers, tax deferrals, property tax, and rent rebate programs. But in almost every state and almost every county, the program exists, and in almost every state and county, you have to apply. It is not automatic. In Texas, the senior homestead exemption plus the school district freeze can save qualifying homeowners between $3,000 and $5,000 per year. In Florida, the homestead exemption combined with Save Our Homes protection shields long-term owners from assessment spikes that would otherwise raise their tax bills dramatically. In Georgia, seniors 62 and older can qualify for a complete exemption from school district property taxes, which is often 50% or more of the total annual property tax bill. In New York, the Enhanced STAR program provides an additional exemption for seniors 65 and older with qualifying income that saves over $1,000 per year in many counties. In Illinois, the senior assessment freeze locks your assessed home value if your household income is below $65,000, meaning your assessment never increases even as surrounding properties sell for dramatically higher prices. In Pennsylvania, the Property Tax and Rent Rebate Program provides rebates of up to $1,000 per year to qualifying homeowners 65 and older with income limits based on calculations that exclude half of your Social Security income, making more retirees eligible than realize it. The process to apply in almost every state is straightforward. You call your county assessor's office, you bring your driver's license, a copy of your deed or most recent property tax statement, and proof of age. The entire appointment takes approximately 20 minutes. In most states, you can also apply retroactively for prior years you missed, which means the refund you can claim is not just for this year. If you have owned your home for 2 or 3 years and never applied, you may be able to claim multiple years of refunds in a single application. Refund number 3 is the state income tax that millions of American retirees are paying on retirement income their state does not actually tax. This is the refund that generates the most frustration because it means taxes were collected on income that the state never had the legal right to collect. And the mistake often gets repeated year after year because neither the state government nor the tax preparer noticed it was happening. The states with full retirement income exemptions include Pennsylvania, which completely exempts all pension income IRA distributions, and 401k withdrawals from state income tax once you reach retirement age. Illinois, which exempts all retirement income despite having a 4.95% flat income tax rate. Mississippi, which exempts all retirement income at the state level. Iowa, which phased in a full exemption for residents 55 and older, that is now fully in effect. And states with partial exemptions include New York, which allows a $20,000 per person exclusion on pension and retirement income. New Jersey, which excludes up to $100,000 for married couples 62 and older filing jointly. If you live in any of these states and your state tax return does not show a retirement income exclusion, you need to pull out your most recent state return today. Find the line where the retirement income exclusion should appear. If it shows 0 or if the line is blank, your preparer did not apply it. The fix is amended state returns for the prior years you overpaid. Most states allow you to go back 2 to 3 years. In a state like Pennsylvania, where the retirement income exclusion applies to all pension and IRA income, combined even modest retirement income of $30,000 overpaid at the 3.07% flat state income tax rate represents $921 per year in taxes the state never asked you to pay. 3 years of overpayment in that scenario is $2,763 in refunds you are owed right now and can still claim. Refund number 4 is the estimated tax penalty waiver for new retirees that the IRS makes available but almost never tells you about. When you retire, your income sources change overnight. Instead of a paycheck with automatic withholding that your employer managed for you, you begin receiving Social Security, pension payments, and IRA distributions. Each of these has completely different withholding rules, and none of them communicate with each other. Social Security withholds nothing unless you specifically file a Form W-4V requesting it. Your pension withholds based on a Form W-4P you filled out at retirement, often under stress and without a clear understanding of your new tax situation. And your IRA custodian defaults to either 10 or 20% federal withholding, regardless of what your actual tax bracket is. The result is that most new retirees discover in their first April after retirement that their total withholding was not enough to cover their full federal tax bill. They owe more than expected, and then they get charged an underpayment penalty on top of what they already owe. It feels like a punishment for not understanding a system that nobody explained to them. But here is what most new retirees and most tax preparers never raise. The IRS has a specific waiver for exactly this situation. If you are 62 years old or older and you retired in the current or preceding tax year and you had reasonable cause for underpaying your estimated taxes, the IRS can waive the penalty entirely. You request it by filing IRS Form 2210 with your return and checking the box that applies to your situation. One form, one checkbox. The penalty disappears. If your preparer filed your first retirement year, return without Form 2210, and you paid an underpayment penalty, you can file an amended return within 3 years of the original filing date and claim the waiver retroactively. The penalty itself is typically a few $100s, but the more important lesson is the system going forward. The safe harbor rule says that if your total withholding and estimated payments for the year equal at least 100% of your prior year total tax liability, you will never owe a penalty regardless of what you owe at filing. You can meet that safe harbor simply by adjusting your withholding on your Social Security benefit through Form W-4V and adjusting your IRA withholding percentage from the default to your actual bracket. Those two adjustments made once protect you from underpayment penalties for the rest of your retirement. Refund number 5 is the one that applies specifically to retirees who recently left higher-paying jobs, and it is the most time-sensitive refund on this entire list because every month you wait costs you money you cannot get back. This refund is about the Medicare IRMAA surcharge, which stands for Income-Related Monthly Adjustment Amount, and it is a surcharge that Medicare adds to your Part B and Part D premiums when your income exceeds certain thresholds. In 2026, the IRMAA threshold starts at $109,000 of modified adjusted gross income for a single filer and $218,000 for married filing jointly, according to the official 2026 Medicare data confirmed by MedicareResources.org. Above those thresholds, Medicare adds surcharges that range from $81.20 per month up to $487 per month on your Part B premium alone, and separate additional surcharges on your Part D prescription drug premium. At the lowest IRMAA tier, just crossing the $109,000 threshold by even $1 triggers an additional $1,052.40 per year in Medicare surcharges, according to Kiplinger's June 2026 analysis. At higher income tiers, the maximum surcharge can reach $6,936 per year, according to 2026 IRMAA data from wecanhelpyou.org. And here is the problem that affects every American who retired recently. Medicare calculates your IRMAA surcharge using your income from 2 years ago. Not your income today, not your income last year, 2 years ago. Which means if you were earning a salary of $120,000 or $150,000 or $200,000 in 2024 and you retired in 2025, your 2026 Medicare premiums are still being calculated based on that 2024 income. Medicare does not know yet that you retired. It is still looking at the last tax return it received. The result is that you are paying IRMAA surcharges based on income that no longer exists. Income from a job you no longer have. And that surcharge will continue every single month until Medicare's 2-year look-back catches up to your actual retirement income, which can take 1 to 2 full years without any action on your part. But you do not have to wait. The Social Security Administration confirmed that retirement qualifies as a qualifying, life-changing event that allows you to appeal your IRMAA surcharge immediately through Form SSA 44. That form is called Medicare Income-Related Monthly Adjustment Amount Life-Changing Event, and it is available on the official SSA website at sa.gov. The SSA confirmed directly on their official page at sa.gov/Medicare/lower-IRMAA that you can call 1-800-772-1213 and tell the representative you want to lower your IRMAA. You can submit the form online, by fax, by mail, or in person at your local Social Security office. You will need documentation of the life-changing event, which for retirement means either a letter from your former employer confirming your last day of work, your final pay stub showing the end date, or a pension statement showing the retirement effective date. According to Greenbush Financial Group's January 2026 analysis, once approved, the SSA recalculates your premiums based on your current retirement income. Any excess premiums you have already paid will be reimbursed typically via direct deposit or a mailed check, and your future premiums will reflect the lower recalculated amount automatically going forward. According to the actionbenefits.com advisor guide from May 2026, IRMAA appeals typically take 30 to 90 days to process, and if approved, adjustments may be retroactive to the date of the qualifying life-changing event, often resulting in refunds for overpaid premiums going back to when you actually retired. The IRMAA surcharge at the lowest 2026 tier adds $1,148.40 per year to your Medicare costs, and at higher tiers, it can cost thousands of dollars per year more. For a retiree who retired in late 2024 and is currently paying an IRMAA surcharge based on their old working salary filing, the SSA 44 immediately eliminates that surcharge for the remainder of 2026 and prevents it from continuing in 2027, while Medicare waits for your 2025 tax return to show your lower retirement income through the normal 2-year process. Here's what you need to do this week. For Refund 1, pull out your 2025 federal return and look at the deduction section for the senior bonus deduction. If it is not there, call your preparer and say these exact words: I need to file an amended return using Form 1040-X. I believe the senior bonus deduction from the One Big Beautiful Bill was not applied to my 2025 return. For Refund 2, call your county assessor's office this week, not the tax collector, the assessor. Say these exact words: I am over 65 and I own my home. What senior property tax exemptions am I eligible for, and can I apply retroactively? For Refund 3, search your State Department of Revenue website for the words retirement income exclusion. If your state exempts pension or IRA income, check your most recent state return for the exclusion line. If it shows 0, call your preparer immediately. For Refund 4, if you paid an estimated tax penalty on any return filed since you retired, call your preparer and ask specifically about IRS Form 2210 and the retirement waiver for taxpayers 62 and older. You have 3 years from the filing date to claim it. For Refund 5, look at your most recent Medicare premium statement. The standard 2026 Part B premium is $202.90 per month. If you are paying more than that and you retired in 2024 or 2025, call Social Security at 1-800-772-1213 and ask about Form SSA 44 and the life-changing event appeal process. Bring documentation of your retirement date. The programs exist, the outreach does not. The government created every one of these refunds specifically for retirees, but it put the burden on you to discover them, understand them, apply for them, and claim them. Every month you wait is another month of money that should be in your bank account sitting in a government office instead. If you have any questions about what we covered today, drop them in the comments below and we will get to every single one. If this video gave you information you did not have before, please like it and share it with someone who needs to see this right now. And if you are not yet subscribed to Sally Krawcheck Retires, subscribe right now so you never miss a video like this one. We will see you in the next one.